Welcome to the Real News Network. I'm Paul Jay, and today we're in Hadlime, Connecticut with Jane DiResta. Thanks for joining us, Jane.
Thank you for having me.
So, Jane is the author of The Evolution of U.S. Finance. And Volume 1, for those of you that are, some of you I know are preoccupied with this, is the history of the Fed. And the whole entire book is about the whole development of U.S. finance. And U.S. finance, Jane, is one of the things that has gotten us into the trouble we're in. Although we're in a weird moment of a recession. We're told we're in the beginnings of a recovery. The stock market's up, bank stocks are up, bank bonuses are way up, and so is unemployment way up. So first, let's start with how do we get into this crisis, which seems to be deepening for most ordinary people?
It is deepening for most ordinary people, as you say, because of unemployment. But it's not over by any means. Many of us believe that the same things that brought us to this place last year are now building up to give us a second piece of the storm. And that is the speculative activities of our financial sector, which are ongoing. And they involve proprietary trading, leverage, and the funding operations that make it possible to make an enormous amount of money and to inflate the balance sheets of these institutions. What we're seeing now in 2005 through 2007, many of these institutions almost doubled in size globally. Even England points out that at that time, the balance sheets of its banks grew by 3 times.
So give us some examples. What is proprietary trading, and how did it help get us where we are?
Proprietary trading is when an institution trades for its own account, not for its customers.
So just so a place like Goldman, normally some
right.
pension fund would come and they say, here's $1 billion, go make some money for us. Right. So instead of that, they're doing what?
They are buying assets on credit for their own account in order to increase their profits so they can pay those huge bonuses. So proprietary trading does nothing for the customer, and it does nothing for the economy. This is just an inside game, a speculative game.
So their answer is, well, I'm Goldman Sachs. We're here to make money for people that own Goldman Sachs. So what's wrong with this?
Well, it gets them into trouble because in order to make that kind of money, they have to borrow a huge amount of money. That's called leverage in relation to their capital. And what we know about that in terms of 10 years ago, because we have the data or the information now, long-term capital management was borrowing almost $100 for every $1 of their own money, their capital.
So give us an example of what one of these kind of trades would look like.
Well, the very large amount of proprietary trading that was going on 10 years ago and going on now, somewhat differently, is you borrow a low interest rate currency somewhere in the world. You buy a currency that has a higher interest rate and invest in the assets of that higher interest rate country.
So you look around for an economy that's in recession, that's trying to attract capital.
Right.
So they have really low interest rates on borrowing money. You turn around and bring it here.
That's exactly right. In the process, of course, you depress the currency of the country that you borrowed in, and you raise the value when you buy another currency. You always raise its value. And so then you're getting 2 things. You're getting a difference in interest rates, that is a profit, and a difference in exchange rates that also gives you profit.
Now, you were off camera, gave me the example. For example, you might borrow yen at one point and come here and buy T-bills that are paying 3 or 4 points.
That's exactly right. And so you've got a nice spread there. And you've done this for, say, 3 months, and then you get out of the position and you take your money, and then you do it again.
For 2 or 3 points to be meaningful, you got to have a lot of money in play.
Exactly. So where are you going to get that money? You're going to get it from other financial institutions. In other words, what we had was financial institutions borrowing from one another, borrowing in London, New York, Singapore, wherever, and using this money to speculate. I'm not just the only one who says speculation. The International Monetary Fund at a given point said the global market has become a casino. These are people who were watching it very closely, and they were absolutely right. So the borrowing from one another part of this game means that you have counterparty problems. You have this web of interconnections within the financial sector. I owe you money, you owe me money. I don't know how much I owe you. I don't know how much you owe me. And we can't quite figure the whole thing out. It's somewhere on the books, but it's a chain that can unravel. So you have two things going on with proprietary trading. You're blowing up the balance sheets of these institutions on the one hand. On the other hand, you're creating this web of counterparty connections. Anything that disturbs the system, that leads to a lack of confidence, because all of this is not transparent. Nobody knows how much anybody's leveraged or how many counterparties they have, etc. Stops the system. It's like the music stops, and there's a couple of missing chairs here.
So it's the Ponzi scheme, essentially.
It's
a confidence game. As long as all the players have confidence the game will keep going, we can keep playing. And there's so much money, who cares? And at some point, maybe this ain't someone's onto this.
Exactly. So when they lost confidence in themselves, what we had was a run on the financial sector by the financial sector. And it all stopped. It wasn't us running to the bank and taking our money out, as it was in the Depression. This was a new kind of phenomenon that they were.
So essentially, a Goldman or an institution like that, they know how artificial their books are, and if they've loaned money over here to one of the other financial institutions, everybody knows they're playing a confidence game. So at some point, they all have to stop because the whole thing has no real underlying value.
Right. And at the same time, what is going on here is that when they do stop, and I owe you money, okay? You say to me, you've given me these assets as margin accounts for the money that you owe me. Well, I think that you need to give me more margin. You need to give me some more assets. If I do that, then I have to take a charge against my capital. In other words, I have to say, my whole book is not worth what it was. So this amount has to come out of my capital to balance my books. Having done that, of course, I have less capital. And I'm on my way to insolvency. At the level at which they were gambling, insolvency spectacularly fast was upon them. And that was what terrified everybody and which led to all the activity that went on in 2008.
Now, one of the pieces of this, because one of the biggest pieces of what they were bundling and selling and using as supposedly an asset, were all the subprime mortgages, especially in California and Florida. And as we know from this series we just published recently from McClatchy, one of the ideas was, well, real estate can never go down in Florida and California. So at some point they realized this thing is unraveling, that people just can't keep buying and borrowing when they don't have any real wages and real income.
Absolutely right. I mean, the reality of what was going on with the household sector, no wage increases, increases in debt. Debt as a whole phenomena in the United States had gone absolutely past the red bars or whatever warning signs should be there. The household sector had gone from something like 64% of GDP in its borrowing, and that was high, historically high in 1997, up over 100% in 2007. The same had happened to the financial sector. They were up from 64% also to 114%. That was the leverage. That was this enormous putting on of assets that was going on. And all of this, to step back a piece, was because of the role of the dollar. The dollar was the key currency. Money was flowing into the United States from around the world because it was the safe haven. It was where the assets were. And the central banks were putting their surplus earnings on what they sold us into treasury bills. So you had enormous liquidity. I mean, just an immense amount of money. And the financial sector was adding to that because they were, as economists would say, monetizing debt. In other words, every time they went through this proprietary trading game and pledged assets, they used existing assets as margin to borrow, to buy more assets and put them on the balance sheet. So now you're just stacking up the balance sheets.
with essentially phony evaluation of assets.
Right. The subprime problem was exacerbated by the fact that a given pool of mortgages could have some very good mortgages in it and subprime, and nobody knew what was in there. How much was good and how much. They did, at the time, they didn't think about it.
I mean, we saw in the McClatchy series that in the 1990s, this New Century Real Estate that was one of the ones accumulating a lot of mortgages and then packaging and selling them to Goldman. In the 1990s, 100% of these mortgages were being reviewed to see if people could actually pay. By 2006, 10% of the mortgages are being reviewed. Like, they didn't even care.
That's right. And so what you have is, back in 1984, a piece of legislation that allowed this to happen.
Okay, next segment of our interview, let's talk about that. Like, we all thought, us ordinary citizens, there's some regulations about all of this. How could the banks go wild? And so let's talk about how that happened. Please join us for the next segment of our interview, Banks Going Wild, with Jane DiResta. Welcome back to the Real News Network. We're in Hadline, Connecticut with Jane DiResta, and we're talking about banks gone wild. Thanks for joining us again, Jane.
Thank
you.
The
first segment of the interview, we kind of talked about the dynamic of this bank Ponzi scheme, which from the outside seems oh so complicated. But once you actually start to understand how vulgar it is, it starts to sound like an American kleptocracy. It's not that much different than the kind of straightforward stealing that goes on in underdeveloped countries. In fact, maybe worse.
Yeah, that's very much so. I think, that there's another thing that to come into this, and that is the change in the structure of U.S. finance. And we call it securitization. And it is a phenomena where a bank makes a loan and sells it to an investment bank, who then pools it with other loans and sells the shares in that pool of loans to your pension fund, your mutual fund, etc. The insurance company that has the insurance on your car, your mortgage, etc. Securitization pushed a kind of asset-backed securities, mortgages as well as car loans, credit card receivables, etc., all across the financial sector. Everybody was pulled together in these asset pools.
And globally, everybody's
and
getting
globally,
in on it.
Exactly so. So, how did this come about? Well, we used to have a system coming out of the Depression of regulation, good regulation. One of the factors there was that there was a ceiling on deposits. In other words, what a bank could pay in order to the depositor. And this kept interest rates reasonable, and it kept stability in the system. It protected the household sector and the business sector from volatile rates, from sharp rises, increases in rates, etc. Along comes the external market, the euro markets, with the American banks overseas dealing in dollars offshore. They didn't have any restrictions like that. They could charge whatever interest rate they wanted. And at a given point, when the Fed was trying to cool the economy, they brought all this money into the country.
What period are we talking about?
This would be the end of the 70s, and that caused the havoc that ended in the dollar then floating.
This is when interest rates are in double digits.
No, that was at the, the original thing with the money coming in and the euro market was the end of the 60s. Into the 70s, then interest rates go sky high. You've got all of this interaction between national markets and external markets, money flowing back and forth here. Central banks can't keep control over the interest rates. So in 1980, legislation came along and said, ending the ceilings. This meant that banks and thrifts, what we called the savings institutions that made the mortgages, couldn't do it anymore. If you don't have that ceiling, how can you lend for 30 years? I mean, you've got a loan that is for 5% for 30 years, You're attracting funds that you've got to pay 10%. The thrifts, as we recall, in the 80s were going bust, hand over fist. So then you have the situation in which securitization comes in. The idea, well, we'll make the loans because we're good at that, and we'll sell them. And they won't hold them in the books. We'll sell them to people who can. Insurance companies, pension funds, et cetera, they can hold these long-term things.
Would they argue, well, what's wrong with spreading out the risk?
You created then a market that shifted from a bank-based market to a market-based market, and there are different rules. In a bank-based market, what you have on your balance sheet, you don't have to market to market. If you're holding tradable instruments, which is what securitization is all about, liquidity. Yeah, I'm holding a tradable instrument, but I can sell it, right? So, I'm not holding it for 30 years. The only problem is if the price goes down, you have to market to market. And that's where you got into this whole regime of the capital of the institutions all across the system absolutely evaporating.
So, in simplest terms, they play this casino speculative game. Individually, the people playing it are getting fabulously wealthy. They know someday it's going to crash, and après-moi la déluge. Mm-hmm. But then there's no consequences, because in the final analysis, the government comes in and says, "Oh, don't worry, you're far too important to the economy to fail. So we're going to make sure that you played insurance through AIG. We'll make sure AIG has the money to pay you off." And, no truth, no consequences. And here we are, and is it still not just all happening again? Like, have we learned anything? Has anything changed? Or are we just heading, as you said before, is it all going to happen again?
It is happening again. And there are a number of people now out there writing about the fact that we have the carry trade going on again. Now they're funding in U.S. dollars because the interest rate is so low, and they are sending money to emerging market countries and to some extent to Europe as well, which has a slightly higher interest rate than we do. So they're all back in business. When these institutions like Goldman Sachs say that they have made all these profits, it's on proprietary trading. Did it do anything for the economy? No. I mean, do we have credit going out there? Everybody will agree, including Bernanke. The banks are not lending to households and businesses. The banks will say, well, they're not creditworthy. We're not creditworthy. We are up to our ears in debt in the aggregate, the American household. Businesses are not doing all that well either, so, there is a problem for them as well. And the banks are saying, but look how we've stabilized the system because we're making profits, and now we pay our bonuses again.
With this globalization of the world economy, there's two games going on. One is you can play workers' wages here against worker wages there, because it's so easy to move production from here to there now in most industries.
That's right.
Which drives wages down everywhere.
Everywhere.
And now you can play economies against each other. Well, that one's in recession, so we're going to go there and borrow the money. And this one is trying to attract capital, so we'll go over and buy here where they're going to pay higher interest rates. And they get to pay recessions off against each other.
That is true as well. But
so what do we do?
Well, and, we have to go back to a regulatory system, and we have to stop the game. And there are ways of stopping it. First, we need to go back and do some of those regulatory things that we got rid of under Reagan and Thatcher, when the mantra was free markets, and look at what we call quantitative controls.
Okay, let's do that in the next segment. So, next segment of our interview, we'll talk about what we can do about the global kleptocracy. Please join us for the next segment of our interview with Jane DiResta. Welcome back to Hadlime, Connecticut, Real News Network, and we're with Jane DiResta. So we've been talking about the global financial crisis, the global Ponzi scheme, and we're talking about what can really be done about the global kleptocracy. So you've been on the Hill testifying about what kind of regulation you think is needed. What have you been saying, and is anybody listening?
Well, one never knows if people are listening, and unfortunately you suspect they are not. However, it was not totally a silent response. I was arguing that we have to stop proprietary trading, and we do that in a couple of ways.
Okay, I'm just going to remind viewers that may not remember the explanation for the first time. These big investment banks normally take pension fund money and other people's money, and they invest it for them so they can make money for the pension fund, except they got very interested in making money for themselves, which they did with highly leveraged bets, and currency speculation, subprime mortgage speculation, and trying to just make themselves richer for bigger bonuses.
Right, and borrowing from one another, which meant that they had created a web of counterparties, which was the domino effect. If I go down, you go down.
Okay.
So what do you do about it? How do you fix it? Well, okay, leverage. We go back to the old leverage requirements. In 1999, we passed something called Gramm-Leach-Bliley Modernization Act, which did a lot of bad things, including ending Glass-Steagall, but concentrate here on the fact that it allowed banks to borrow more for both traditional and non-traditional activities. Okay, banks presumably take deposits, but now they can go into the repurchase agreement market and borrow the money, as I said, from other financial institutions. So repurchase agreements or borrowed money is a creeping up of the liabilities of the banking sector, which used to be just all deposits, CDs, but essentially a deposit
something
instrument.
Real.
Yeah, right. That was allowed to happen in 1999. We need to go back and put back on, and I forgot what happened to the investment banks. In 2004, and this is widely known, Henry Paulson, then head of Goldman Sachs, went to the SEC and said, we can't compete with the European banks. They can leverage up to 30 or 40 for every dollar of capital. They can borrow another $30 or $40 for every dollar of capital. You only allow us to do $12 or $15 at the most. The SEC said, yeah, global competition is important. You can go to 30, which is, of course, where Bear Stearns was when it went down, right? And Lehman, et cetera.
And no surprise that the head of the SEC at that time was someone who had previously been a lobbyist for the finance sector.
Well, that is true, too. So we need to go back to the old leverage requirements. Put them on very strictly.
Well, before we get more into what should be done, let's just talk about that moment in the late 90s. Why did the regulation, what were the forces at play? And this is under Clinton, so it's not a Democrat-Republican thing here, really. Why were the regulations overturned? I mean, everyone knew what had happened in the 30s, so what are the forces at play to kind of unravel the regulatory environment?
The fact of the matter is Wall Street was in ascendancy at that point. And we remember that Robert Rubin was in advising initially and then became Secretary of the Treasury. It's a situation in which they were out to get what they wanted, and what they wanted was less regulation. We have what we call in economics financialization. We have a situation in which, as we saw over this period of time, financial institutions' profits as a share of total corporate profits were higher than they were for the producing sector, companies that make things. So this is where they won.
Is part of this problem that, and it goes back, we talked in the last segment about globalization playing recessions off against each other, and maybe even more importantly, playing workers' wages off against each other. Is part of the reason that this all happens is because there's just not enough money to be made in the productive sector anymore? That people just don't have enough real money to buy things. And there's just much more return on capital over here in a bunch of capital Ponzi schemes.
Well, in some sense, yes, because, of course, what happened was that we reamed our manufacturing sector by allowing the dollar to become the global currency and a strong dollar. Strong dollar policy was the policy of the Reagan administration, the Bush administration, the first one, the Clinton administration, and the Bush administration, and even now we're talking strong dollar, right? Economics 101 will tell you this. You got a strong currency, You're not going to sell anything abroad. Somebody can outprice you.
But it's good if you're buying cheap money over here and want to make money over here.
But you are also not going to sell anything at home. So the deal was we gave Wall Street the money power. Strong dollar, great for Wall Street, make a lot of money. Very bad for Main Street. You can't make money. And very bad for wages. So all of these things are very much linked. The lack of increase in wages, American families then going out and going into debt is the only way they could possibly maintain their standard of living. And we then became the consumer of last resort, buying everything that China made.
Okay. In terms of regulation, 3, 4 things that people should say, I want that to stop this from happening again.
You've got to go back to the old leverage requirements and say, this is how much you can borrow. No more. You also can extend the margin requirements that we have had on stocks since 1933, meaning you want to buy a stock, here's how much money you have to put down. The Depression came along because people put down 5 cents and bought a $100 stock. So manage that. That needs to be managed across the system, mortgage-backed securities, all kinds of things, and commodities, and oil. Because what we see is this liquidity in the market that moves from market to market. That's why the stock market is up. Next thing you know, it'll be the oil price again, moving right up as they begin to speculate in oil futures. So we have to stop it at that level. We've done it before. These were restrictions that were removed or were not applicable in the case, the speculation used to be all in stocks, and we need to go there again. The other thing we need to do is to put a limit on how much you can borrow from another financial institution. In other words, we have in the banking acts in the United States already, you can only lend to a customer 10% or 15% of your capital in relation to your capital. So you don't want all your eggs in one basket. That's the point. Diversification.
And would you stop proprietary trading?
If you could not borrow from other financial sectors, the other financial institutions, yes, you'd stop it. So those are the things that you could do. Any one of them will help.
They seem no-brainers. It's rather obvious it's needed. And it doesn't really seem to be happening. So in the next segment of our interview, let's talk about the politics of all of this. Why, according to President Obama, we were looking at the apocalypse. Why aren't we stopping that? So please join us for the next segment of our interview with Jane DiResta. Welcome back to the Real News Network. We're in Headline, Connecticut with Jane DiResta. We're talking about the financial apocalypse redux. We got a fair sense of how vulgar this cash grab has been by the financial institutions. In the last segment, you laid out 4 or 5 what are pretty obvious things that would at least go a long way to stopping this from happening again. But it seems like no serious regulation is really seemed to be about to be enacted. President Obama, when he spoke to the nation selling the bank bailout, he said, yes, there's been too much greed, but really we're doing all this for Main Street, not for Wall Street. What do you make of the performance of the Obama administration in terms of exposing to people what's really going on and doing something to stop it?
I'm not sure that the president knew what was going on. I think this is not his field. He was relying on the experts he chose, and the experts he chose would like very much to have, as would the financial sector itself, everything returned to January 2007. And they think that was the way to go, that if they could just hold it up, prices would come back, assets would regain their value, and so they have this false dawn that we talked about before, where, there seems to be profits in the financial sector again.
Well, before we get back into that, I want to just back up one step. He didn't have to pick the people he picked. He picked the people who were all the players in the creation of the mess in the first place.
Well, that's right. And the complaint has been very real about that. Many reporters now ask that question. And so, presumably, it's his choice. Many of us feel these people should go. And we're disappointed that other voices are not being heard, and they're not. There are famous stories out there about various other voices and so on. I won't get into that. I think the issue is also that the Congress was not hearing other voices as well. And so there is something called the Americans for Financial Reform, and the group that I'm part of, which is a group of economists and analysts who are for financial reform as well, up at the University of Massachusetts, but of course our group is much broader. And we've been clamoring to be heard. So far, a few of us have been heard, but under great pressure to have this kind of witness on. You have the situation in the Congress where the Banking Committee, what we used to call the Banking Committee, Financial Services Committee now, has grown astronomically in numbers. There are over about 70 members of the committee now, and there's not much room for an audience in the room because that's where all the members are. And it's not a deliberative body. It's a body that necessarily has to have strong leadership, and it's getting it from Chairman Frank. But it does preclude a lot of discussion. That means a lot of things are not getting examined. When I was there, what I saw was a kind of a pushback on the part of Democrats as well as Republicans. And some of that had to do with the move to give the Fed a great deal more power. And there's concern about the constitutional issues. There's concern about the concentration of power issues. There's great sympathy for Sheila Bair, the head of the FDIC, who feels it should be a committee, a commission, making the determinations and not the Fed.
This is about who's going to be the regulatory body.
Who's going to be the big systemic regulator? Who's going to really say, this should happen, you have to die, institution, etc. So these fights are now beginning to emerge, and I think they will be there with us. The major difference between positions is the administration, and so far the Financial Services Committee, are voting for discretion. The rest of us want rules.
Meaning the Fed would be the regulatory body, and the
And
Fed would have discretion.
Go forth and do
This
good.
day we're going to do this, and that day we're going to do that.
That's right.
And it's up to us to decide what's good for the economy.
And what we feel
And just to remind everybody, the banks control 2/3 of the votes of the Fed and most of the decisions.
Well, of the banks, of the Federal Reserve Banks. So the Federal Reserve is a problem. And the head of the AFL-CIO, who testified on the day that I did, said, we can't go along with that unless you democratize the Fed. So the issues are getting to be rather heated, and they should be. There's a lot of power that is being pushed around. And I think people were really distressed because the idea was, on the one hand, this commission would be formed. It would be informative, it would collect data, it would tell everybody where they saw the problems, but the real power would be with the Fed. And at the same time, the Treasury also would gain in power because the Fed would have to go to the Treasury and get written permission to do emergency actions. So this did not sit well with the Congress at all. The politics of it in general are also, there's so much money there. And lobbying money is huge. You know that in the healthcare legislation and so on. But it's very, very big. And so what can we do on our side? Well, Rich Trumka sits there and he's got AFL-CIO sits there with a lot of members. The Americans for Financial Reform has 200 members, a group of NGOs, as we call them, non-governmental consumer groups, labor unions, and AARP, and we know how many millions of members that is. So what we can simply try to do is remind the Congress that we're out there.
Do most Congress people understand the dynamics of how all this worked? Or are they bamboozled themselves?
No, they are. They are bamboozled. I think, that probably they don't have a lot of time to read. I think some of the reporting that has been done now, not in the past, but now, is excellent. They don't necessarily have time to read it, and that's why we feel that they should be listening to other voices, because they're going to come and listen, or they'll watch it on the screen in their offices, etc., hearing.
Do they get that the profound global crash that's triggered by this Ponzi scheme in the finance sector is very likely to happen again? Do they get this?
They don't. The numbers for GDP went up at the same time that there was a big meeting of a lot of people who were saying the numbers are no good. We've got to change it. We've got to spend money to collect the real data.
What is going up if we're approaching 20% real unemployment?
Unemployment,
then what
exactly.
does it mean?
Yeah, exactly. So why is this?
Or if it's just some stimulus money hitting, then what happens when that's gone?
They aren't able to discriminate on what is going on overseas and how much that we're counting as our part of our GDP.
And Ponzi schemes are part of GDP.
Exactly. So they see the financial sector making money. They don't like the bonuses. The compensation issue is very big. What they don't understand is they couldn't pay these bonuses if they weren't doing proprietary trading. Stop it at the source. Don't just say, oh, you can't pay more than X. That's not enough.
So maybe there needs to be this several million person march to Washington, like down with the American kleptocracy.
Well, something like that might help.
Next segment of our interview, let's get into some people's favorite subject, the Fed, because it's a big debate. What should be the role of Fed? What is the Fed? And please join us for the Fed on the Real News Network. Welcome back to the Real News Network. We're in Hadlime, Connecticut, with Jane DiRista, who is the author of The Evolution of U.S. Finance. And the first volume of this is the history of and the creation of the Fed, the Federal Reserve. Thanks for joining us again.
Thank you.
Some people believe, and I guess one of the more outspoken about this is Ron Paul, but Dennis Kucinich on the other end of the political spectrum has made some of the same points, that the Fed is kind of the root of all evil. The fact that, number one, it's so controlled by private banks. Number two, it prints money at the whim of banks and not necessarily what's good for the society. So tell us a little about the origins of the Fed and what you make of it now.
Well, the Fed came in after a major financial crisis, 1907. It took six years for the Federal Reserve legislation to be passed under Woodrow Wilson, and big struggles as to who was to control. The bankers obviously wanted a central bank that was run by the bankers altogether. So the compromise was part public and part private.
What was there before the Fed? Who printed?
Nothing.
Who printed money?
There was the national banks themselves printed money. Banks printed money. Private banks. And so we had the national bank note that had actually come in the 1860s and superseded the state bank notes, etc. And there were rules and regulations. You had to have a certain amount of capital, species, gold, etc., in relation to your note issue. Nevertheless, I mean, it was not an adequate system. It resulted in consistent panics. The idea was that you needed a reserve system, a central place to keep reserves for the system as a whole and lend them out when there was trouble around the country. So that was the rationale for 12 banks around this country to keep all the regions under some kind of access to credit, and the split between public and private. So as you probably know, the Federal Reserve banks, all 12 of them, have boards of 9 members, 6 of which are appointed by banks. And they, in turn, those boards, appoint the presidents of the Federal Reserve banks. And those presidents sit on the Federal Open Market Committee, which makes monetary policy, on a rotating basis, so that you have 7 votes of the Federal Reserve Board and 5 votes from the Federal Reserve banks, 12 votes altogether on a policy action. People feel very strongly.
Just back up. But the president of the Fed is appointed by the President of the United States.
The chairman of the Fed, yes. All the 7 members of the Federal Reserve Board are appointed by the President and confirmed by the Senate. Now, back up again and say, and this is a very important issue for both sides, Paul and Kucinich, it is under the Constitution, it is Congress that has the power to make money and regulate its value. In 1913, we delegated that to an agency, the Federal Reserve System, and they do it. But there's always been this strong push to say, you got to report to us. You know, we're the guys in Congress who have this power. So the Full Employment Act, which was in the 40s, that said to the Fed, pay attention to price stability, to unemployment, and the production of the economy. Those three things we want you to pay attention to. That's what monetary policy is all about. They sort of strayed away from this, and Humphrey Hawkins came in and reiterated the same position and said, you got to report to us twice a year. We want a full report on just exactly what you're doing in monetary policy. But the Fed also has very important regulatory responsibilities, which have grown over time, and the more so since we have what we call holding companies, which are these huge conglomerates, and the Fed is the ultimate overseer there. The Federal Reserve relaxed the regulations on the financial institutions. They were a major part of doing that. In terms of the subprime situation, they could have reached out under their powers and said, make people put a certain amount of money down when they buy a house. Don't do this and don't do that. And the egregious practices of paying people bonuses the more mortgages they make, irrespective of how qualified the buyers might be. Have you looked at their salaries? No, they didn't ask those questions. So that and the big stuff, the speculation, they didn't stop it. And they didn't even know until Bear Stearns went down, when they suddenly said, oh my God, well, who are the counterparties here? They didn't know that this web was there sitting to explode.
It's counterparties you talked about in the earlier segment,
yes,
where the financial institutions are all borrowing from each other to do this proprietary trading.
Exactly. And of course, when they let Lehman go, they then found out just how strong this web was. So
there's a piece of legislation that Ron Paul's proposed,
yes,
and many others have supported to try to create some accountability. Where is that at?
It's got 270, I think that's the number, sponsors, which is a very big chunk, and they're from both sides of the aisle. What they want is the GAO, the Government Accountability Office, which is an arm of the U.S. Congress also, to go in and look at the Fed and say, what have you done? Tell us. To whom did you lend? We want an accountability of what's been going on during this crisis. And the Fed has always pushed that away and said, they can't get into monetary policy. We have to depoliticize monetary policy. Congress is beginning to think, maybe not. You know, we really want to know all of this. So that pressure is on. Where that legislation is, well, it's not out of committee and it's not on the floor yet. The idea being the reform provisions are more important than this piece. I'm not sure that makes people happy.
Has the Obama administration said anything about the legislation? Are they for it? Are they against it?
I don't know that they have said anything. I don't think that they have taken a position. I think they've probably been careful not to do so.
Because the Fed has played a critical role, either through its absence or through making cheap money available, as they are now. In this entire crisis.
Oh, yes.
The Fed is an enormous piece of this puzzle.
Very much so. And many people would take the view that Greenspan's creation of the housing crisis was because he kept interest rates at 1% for so long a period of time, increased the liquidity in the markets by such an enormous factor. And there was a wonderful prescription, if you will, out from the International Monetary Fund about, I would say, 2004, where they said to the Fed, raise interest rates. Don't you know you're encouraging the speculation? With rates so low, they've got to borrow much more money. The positions have to be much larger. If the interest rate difference was, in their favor, why they would have to borrow less and we'd have less speculation. So nobody thinks the Fed did a very good job. And the notion of giving it additional power at this point is not one that anybody really wants to face.
A lot of the conversation that's coming from Ron Paul and others is about the whole issue of fiat money and what kind of money, what is our monetary system. So the next segment of our interview, let's talk about what is fiat money and is it the issue or not. Please join us for the next segment of our interview with Jane DiResta. Welcome back to the Real News Network. We're in Hadline, Connecticut with Jane DiResta. We're talking about banking and money and the Federal Reserve. Thanks for joining us again.
Thank you.
So before we get into the fiat money question, let's talk just a little bit about the whole issue of the Fed. And you had said in an earlier segment that Rich Trumka, who's the new head of the AFL-CIO, told Barney Frank, before we're going to support any of your new regulation, you got to democratize the Fed, which I think you agree with. So what would democratizing the Fed look like?
A new piece of legislation has come out from Marcy Kaptur, who is a congresswoman from Ohio. And it is a sort of a first shot at what we need to do. First of all, she says, let's bring the terms down from 14 years to 7 years. These people should not be there for life, as it were. And they don't stay anyway. Very occasionally, a member will stay that long. And the second piece of her legislation is let's have the requirement that the chairman and vice chairman of the Fed will have had to serve on the board already 2 years before they're appointed. The reason for that is really to upgrade the Fed board. I mean, there had just, especially during the Bush administration, people were just appointed to the board, and the assumption was, well, there's only really one person that matters, and that's the chairman. So you don't have deliberation, you don't have different voices. And, of course, the chairman, that was true. That was how the Fed was operated. It ran the staff, and the staff was very limited and narrow in their point of view. I heard one important person say on the staff of the Fed was reported to have said, why didn't the press push us more? In other words, we were captive. They didn't come at us. The world didn't come at us and challenge us.
Should there not be some kind of regulation that prevents people from working for Goldman one day and run the Fed the next? I mean, I think it's just beyond me that there isn't a conflict of interest window that you have to be 3-5 years removed from working from one institution to the next.
Exactly. I think that's another part of democratizing that would be critical.
Well, there's another piece you hear from a lot of critics of the Fed is you can't democratize the Fed. What there should be is a central bank that's appointed publicly that private banks don't run. Don't own a piece
that's the critical piece. That is absolutely the piece that has to change. The concern there was that the head of Goldman Sachs was in the room at the time that they were discussing some of these issues. I mean, because he was on the board of the Fed. I mean, this is
and Goldman's getting to decide whether Lehman lives or dies.
Exactly, and cut your competitor out, if you will. But, also the decision of, are you going to give money here or not? And who's going to get bailed out? And what's the strategy?
So if the Obama administration is serious about financial reform, don't they have to take on the Fed, which means essentially get rid of this Fed and have a legitimate, publicly run central bank? I mean, anything short of that seems to be smoke and mirrors.
Right. And it was attempted back in the 1930s as well, and it didn't go forward at that time either. I mean, the vested interests were very strong then, and they are now. The voices, they want to have their say.
We don't hear almost a word of this in the media. There's practically no conversation in mainstream media about.
No, the Fed is off limits. I mean, they simply it's bewildering. It doesn't seem important, and yet it's terribly important because monetary policy determines everything. I mean, you don't get a strong dollar unless the Fed is willing to actually keep interest rates in the U.S. slightly higher than in Europe and Japan. That will bring the money to the U.S., and that will give you the strong dollar. And if that's your policy because you want to help Wall Street, why, that's what you're going to do. And that's exactly what Greenspan did, except when he decided to keep it at 1% to get out of the bust that he had been in, the bubble that burst, and then got us into the second bubble.
And am I understanding it correctly that the Fed right now is making money available to the banks at virtually 0%, some of which they actually go buy T-bills with and make money, but as you were saying earlier, they can take it abroad and make even more money.
Yes.
And there's, the Fed is essentially, I think it's more than a couple of $1 trillion.
Yeah.
So the Fed is establishing its entire economic agenda independent from any kind of elected representative.
That is true. The other thing about the Fed is it gave away its own powers. It's not just that it deregulated the financial sector, it deregulated itself. It essentially made reserve requirements, which concerns the supply of money, irrelevant. Why? Because the system was growing, banks were shrinking. Banks used to be 65% of the total credit market. They're down below 25%. They carry the burden of monetary policy. Reserve requirements are a cost. If you have to have a reserve requirement that is 10%, then it means that of the deposit you just took in, you can only lend $90. Mutual fund can take in $100 and lend $100. They can lend $100 in Europe, in the euro markets. The same branch of the same bank can do that. So what the Fed gave up was control over the supply of money. And it therefore has to depend upon demand. In other words, the interest rate. It has to say, and even Greenspan in 1993 admitted, it means, well, interest rates have to be a little higher than they were or a little lower to get the job done. So the volatility in interest rates, which plays havoc with investors, the normal investor, and is absolutely ambrosia to the speculator.
So in the next segment of our interview, let's do what I said we were going to do in this segment of the interview. Let's talk about fiat money and just what is the significance of it. Please join us for the next segment of our interview with Jane DiResta. Welcome back to the Real News Network. We're in Hadlime, Connecticut with Jane DiResta. Thanks for joining us again.
Thank you for having me.
We talked about the need to democratize the Fed, even better, get rid of the Fed and replace it with a public interest central bank. The second piece of the Fed that people talk about is the whole question of fiat money. So just start from square one. What is fiat money, and is it the root of all evil?
Fiat money is the full faith and credit of a government without a gold backing, if you will, or without any particular backing other than the ability of that government to tax its citizens. So the concern is that we effectively got rid of gold in our system altogether in the 1940s.
So let's just go back to something you said a little in the earlier segment. So before there's the Fed, you have some big banks, and banks print money. So, and their bank has some legitimacy because in theory they have enough gold sitting in their vault, and they print money not more than the gold they have. And in theory, yes, that's a system that gives you a trustable currency as long as the government's willing to take these notes when you're paying the government taxes or something else. That breaks down. And so just remind us again why that broke down, because a lot of people that are suggesting that fiat money is the root of the problem don't deal with why we got to fiat money in the first place.
We got to fiat money in the first place because there's not enough gold to keep economies growing. If you have population growth, your economy has to grow in order to provide jobs for the new entrants into the labor market. But with finite amounts of gold, how do you do that? One option, which was discussed at the time that we actually went off gold in the system, the global system, in the 70s, when we closed the gold window, Nixon, was, well, why don't we just value gold up? he only got a finite amount of gold, and we don't want to really give Russia a big deal. And then there's South Africa. We didn't really like the politics there either. So what do? Well, okay, so now gold is changed the price. Well, that's discretion, isn't it? If you decide to change the price, what's the difference there between changing the price of gold because it's too limiting and fiat money? Same difference.
So you might as well have fiat money.
Might as well have fiat money, and then have rules and regulations on how the growth should go about. Now, it's all in the banking system or the financial sector. These are the people who help a central bank make money. They make money because they lend, and then they create economic activity, and then that enlarges the money supply. I mean, those are things that are very much linked together. I
mean, in theory, if paper money is going to have value, and it's not linked to gold, which, as you're pointing out, doesn't really tell us what the currency is worth anyway.
Right.
Then what does? I would have thought that money has something to do with the real economy. That if the real economy produces this much wealth, then you can have that much currency. And if productivity goes up, then you can have more currency. And if productivity goes down, you should have less money in circulation. But that's not going on either, is it?
No, but for a while it could go on, or it did to some extent, when let's talk about the Federal Reserve, had control over, as I mentioned in another segment, the supply of money as well as the demand for money in terms of the interest rate. If I raise the interest rate too high, you're not going to borrow. But if I also put a reserve requirement on the bank that rises, it's not going to lend. So that's two ways of controlling how much money is in the system. And we got rid of one of them, the reserve requirement, and so we're not controlling what the banks do. And then you have this external market where there is no control. Now, that was the way we did it. The Bank of England had what they called a corset. In other words, they told the banks how much they could lend every year. The Bank of France, for example, before we deregulated all the central banks, had a situation in which they said, this is very commonplace among central banks, you can increase your lending by X% this year. A little more if it's for exports or some other preferred sector. The Swedes wanted a little more if you'll build more housing, etc. So you have a certain amount of discretion there, and you then look at your central bank and say, how well did you do for us? I mean, have you kept the supply under control? We haven't.
Well, there seems to be no mechanism now other than you can print as much money as you want until you think it's going to be inflationary. And then once it's inflationary, you can raise interest rates and pull some of it out. And then you can, as soon as it starts getting depressionary again, you can start printing it again. And there seems to be no other rationale to it. Either just pour it in and then you can start taking it out and pour it back in again. But it seems to have nothing to do with what the real economy is doing.
No, because the whole speculative thing has distorted it. But during the period before we got into sort of incredible inflation in the 1970s, the situation was much more reasonable, and the Congress would say, well, where's the money supply? We have these measures. What's M1? M1 is, the basic amount of money. M2, M3, get up to total credit. And finally, there were people who were saying, you got to measure total credit. And that was something that the Fed never did.
Well, what would you like to see? What would be a rational monetary policy?
I would say we have to go back to reserve requirements. We have to give the central bank control once again over the supply of money. But since the banking sector is a very small part of our financial sector now, we have to impose reserve requirements on all financial institutions. And the only way that we can do that is by putting them on the liability side of the balance sheet. So we're going to change the whole system. Now people have said this is utopia. But it's also very practical and rational. If you had a situation in which everybody, insurance companies, investment banks, hedge funds, etc., had to have reserves with the Fed. But the Fed creates these reserves, and it puts them as it were deposits from the Fed on the liability side of the balance sheet, where capital is, where the customer funds come in. It does this by buying an asset from that institution under a repurchase agreement.
Okay, make that simpler.
Okay. If it goes into, say...
Describe an actual transaction.
I'm going to talk about a bank that is a regional bank. That is your neighborhood bank. So the Federal Reserve comes to your neighborhood bank and buys $100,000 worth of assets. And it gives you $100,000 of reserves, which sit then on your balance sheet on the left, on the side where the liabilities are, your capital, your customer's fund. What has happened to you as a bank of this size is now you have more liabilities than assets. You're not balanced. Your balance sheet is out of balance. So what do? Well, you got these liabilities. You go buy another asset. And that's how you spur the economy. Now the Fed says, okay, too much. I'm selling back that asset to you, and I'm taking away your liability. You're out of balance again. You've got more assets than liabilities. You've got to sell an asset.
An asset would be what?
An asset would be a loan to somebody.
A mortgage.
A mortgage.
Car loan.
Car loan, anything. So now you've got to strip down your balance sheet, and you're on the asset side. So you're contracting credit that way. The first way you were expanding credit, now you're contracting. So much better than this interest rate thing where, some people are going to pay the higher interest rates because they need the money. It's not consistent. It's not reasonable. And as Greenspan admitted, you got to go either higher or lower with the interest rates. Create the volatility, which does not help your economy, certainly not your productive sector.
Some people have called for banks, some kind of bank, as essentially a public utility, some way to facilitate credit that simply bypasses the private banks altogether. So let's talk about that and other public options in the next segment of our interview with Jane DiResta. Please join us. Welcome back to the Real News Network. We're in Headline, Connecticut with Jane DiResta. Thanks for joining us again, Jane.
Thank you for having me.
Let's talk about other kinds of solutions to the crisis. Some people have made the proposal that there should be some kind of bank as a public utility so that there's a way to get credit without going through the private banking system. Some people have suggested if public option is good for the healthcare industry, then why not for the finance industry? Why not different types of public institutions to facilitate liquidity in the economy? So what do you make of all that? And if you think there should be something like that, what would it look like?
I think that we have mutual institutions which are publicly owned. We've had a long tradition of this, and that was something that was always pushed by progressives. So we had mutual banks, mutual savings banks. We have now credit unions. I'm a member of a congressional credit union, which is owned by its members.
Because you used to be a congressional staffer.
Right. That is one way to go, the mutual system, where we own the institution. I think we need to do more of that in terms of pension funds as well, because they're a huge ripoff. And we need to have people coming together with their IRAs and having the decision as to what the policy should be, how much they're going to pay, because the ripoff in terms of fees, it's your money. And you're trying to get, to a place where you can actually retire. And so much is taken out and traded away in transactions that you may not come out too well. So one way to go, public, is ownership by the people whose money it is.
Credit unions, co-ops,
right, exactly. Now, a governmental institution is something that has been, if you will, eradicated from the language. I was in Buenos Aires at a conference which was in the industrial bank, held by the industrial bank, and they were saying, we're one of the few that has survived the whole Thatcher-Reagan push to get rid of these. I mean, the pressure was on to privatize all of these institutions around the world. But they have a very important role to play. So industrial banks that lend to businesses, small business, we need lending to small business in this country. We need an institution that will do that. Our sort of template for this, if you will, is the Reconstruction Finance Corporation that was put in, interestingly enough, by Herbert Hoover in order to capitalize the banking system at the beginning of the 1930s, and then morphed into a much broader kind of institution under Roosevelt and Jesse Jones, who ran it, and ended up in 1938 creating the Federal National Mortgage Association, which we call Fannie Mae, which was a purely public institution at that time. Subsequently private, quasi-privatized, as we know.
And people point to that as the example of why you shouldn't have public lending institutions.
Yes, because the pressure was on for them to then support the market for mortgage-backed securities. And they began doing this on a small scale at the beginning of the 70s, and by the 80s it was on a huge scale because the mortgage market was collapsing. You know, I mean, I'm not sure you can blame there were a lot of problems with Fannie Mae and Freddie Mac, but at the same time, the structure of the market was shifting. They were pushed into the position of, if you will, sort of being the safety net for a market that was falling apart.
So Fannie Mae doesn't prove that these sort of things are inherently going to go awry.
No, and back in the 70s, when I was working for the U.S. Congress, we were proposing a Fannie Mae for the environment. And the idea there was to support alternative sources of energy, to provide funding for towns and states, et cetera, to clean up brownfields and make use of them. We had support from 2 members of the Federal Reserve Board at that time for that legislation, and a lot of support around. And in the end, the oil companies came in and said, you don't need it. We're going to move in this direction. The market will take care of it. And of course, we see, did the market take care of it? No. So there's always a role for government in areas where the market has failed or will not move. And we have seen that take place before, and we need to do it again.
So didn't the Obama administration have other choices? When they came to power, instead of the billions of dollars going from the Treasury into the bank bailout, the couple of $1 trillion from the Fed, why not create these kind of public lending institutions and directly facilitate liquidity with some kind of public interest agenda? And this is obviously a softball question to you.
Well, I think, that they could certainly have done that, and that's not a new idea. When Franklin National Bank failed in 1974, Henry Royce, who was then my boss, proposed exactly doing that. Take it over, make it a public institution, make it your TVA, if you will, for the banking sector. What we call the public option. This is the model institution. We should try that. It would be a good thing to try. And certainly in terms of we do own these institutions. I mean, my gosh, how much of Citigroup do we own? I think it's somewhere around 36%. So why aren't we, therefore, using our ownership for good public purposes?
So what's the answer to that? Why aren't we? Is the bottom line here the Obama administration? Is this too much an extension of Wall Street?
I think they're kind of uncertain as to whether or not there is sufficient support to do that.
But Obama has certainly appointed people who are not inclined to want to do that. I mean, Geithner is someone who's very interested. Geithner is not a man of public lending institutions.
No, he's not. No, that's right. And so you don't have the support within the administration, and the political people in the administration aren't sure that he would have the support outside to do this. And so we have a vast timidity in dealing with the financial problems we face, and just hope that things are going to turn out all right. But the creativity that we saw back in the 1930s, it ain't there.
Well, I guess the problem is if you're head of one of these investment banks, things usually do turn out all right.
Yes, for you. but not for the rest of us.
Thanks very much for joining us.
Thank you.
And thank you for joining us on the Real News Network. And speaking of financial crisis, don't forget the donate button, which is either here or there, because if you want to see more of this, we need you to click there. Thanks again for joining us.